Welcome to The Debate. Today we're delving into a financial phenomenon that has certainly captured the attention of many retail income investors. We're talking about the rapid growth and, frankly, the significant yields advertised by these high-yield covered call ETFs, particularly those from the YieldMax suite. You see them discussed quite a bit on social media, often presented as a pathway to substantial passive income, maybe even early retirement.
Right. And the central question we need to tackle today is this. Do these high-yield covered call ETFs, the YieldMax ones included, do they genuinely represent a sustainable and sound investment strategy for individuals who are really prioritizing income, or do their inherent structural characteristics and, frankly, their performance dynamics present significant long-term drawbacks that could actually undermine that very goal?
Exactly. And my position today will be that these funds, they do offer a clear utility for immediate income generation, specifically for a certain type of investor profile.
And I'll be approaching this from, a distinctly different angle. While I absolutely see the immediate appeal you mentioned, I firmly believe their fundamental limitations and the structural design itself make them a less than ideal choice if you're looking for long-term income sustainability.
Okay, well, let me start then. The appeal of YieldMax ETFs for income-focused investors is undeniably potent. These funds provide a pretty clear mechanism, right, to generate substantial monthly cash flow. This comes from the consistent sale of covered call premiums, which is an exceedingly attractive proposition for anyone who prioritizes immediate distributions over, say, the volatility of capital appreciation. And this promise of significant monthly income, sometimes social media narratives inflate this to 50%, even 100% annual returns. It aligns directly with that goal many have of achieving financial independence through passive income. So, for investors who are actively seeking to maybe accelerate their path to retirement or perhaps supplement existing income streams, the high payouts from these ETFs like PYI, HOIE, MISTI, ULTI, they certainly seem like a compelling and maybe even practical solution for managing cash flow in different market conditions. This singular focus on immediate, tangible income is what I think really distinguishes them as a potentially valuable tool for a specific kind of investor.
I acknowledge the allure you're describing. The attraction is obvious. But I'm just not convinced that this appeal translates into a genuinely sound long-term strategy. While the high income from these covered call ETFs, including the YieldMax suite, is certainly potent in its promise, a more rigorous examination, I think, reveals they aren't quite the panacea for passive income they're often depicted to be. You see, their underlying strategy, which typically involves synthetic positions and the frequent selling of at-the-money calls with very short expirations, it fundamentally restricts any meaningful upside potential.
Right. That's the trade-off for the premium.
Exactly. But while restricting the upside, it simultaneously retains substantial downside risk. And this intrinsic structural design consistently leads to a pervasive issue: continuous and often significant underperformance compared to the actual underlying assets. This then leads to a subsequent decline in distributions over time and ultimately a detrimental erosion of capital over the long haul. So this makes them, in my view, a demonstrably less than ideal choice for truly sustainable income generation. The perceived income, I worry, frequently serves to mask a much deeper problem of sort of insidious capital decay.
Okay, I understand your concern about capital decay and, yes, the underperformance relative to the underlying assets, particularly in strong bull markets. However, for many investors, the primary objective isn't necessarily to match the, let's say, explosive capital appreciation of highly volatile growth stocks. Their focus is often squarely on achieving consistent, high distributions. The immediate cash flow these funds generate is a concrete, usable benefit. It directly impacts an investor's current financial situation. And we have seen instances like investors in PLTY realizing a positive return since its October 2024 inception. Or, individuals who've nearly recouped their initial Coney investment solely through dividends. These examples directly illustrate that these funds do provide a return, specifically in the form of tangible cash. So for individuals who are explicitly income-focused, maybe less concerned with unrealized paper gains, that direct payout offers a predictable and usable income stream. Furthermore, and this is important, under certain market conditions, those premiums collected from the covered calls can effectively offset some losses during downturns. We saw this with Misty losing 41% compared to MicroStrategy's nearly 50% loss during a bear market, or TSLY's comparatively lesser decline during the Tesla Elon backlash period. This can offer a degree of relative stability for income investors, a feature I think gets overlooked if you only focus on total return metrics.
Well, while those examples do highlight the immediate cash flow, my fundamental point remains about the long-term total return, because that ultimately dictates wealth preservation and growth. The most critical concern, I believe, for these ETFs is their consistent underperformance in total return, even when you carefully account for all distributions. Let's consider PLTY, the covered call ETF tracking Palantir. It was down 16.3% year-to-date at one point, while Palantir shares themselves were up a staggering 104% over that same period.
A significant divergence, yes.
A huge divergence. Similarly, TSLY, based on Tesla, declined by 45%, whereas Tesla itself was only down about 17%. Even in cases where these ETFs generated some positive nominal return, like your PLTY example since its inception, it still significantly underperformed Palantir by roughly 30% in total return. This pattern is frankly alarmingly consistent across numerous YieldMax offerings. You see HOE's significantly trailing Robinhood, Coney's 132% return paling compared to Coinbase's 329% over the same time frame. The structure, the synthetic positions, the at-the-money calls inherently ensures these funds capture minimal upside from stock appreciation, yet they unfortunately mirror much of the declines. This inevitably results in an effectively permanent share price depreciation. It creates a situation where investors often assume nearly equivalent risk to just holding the underlying stock, but they receive significantly diminished overall returns. This makes the income, in many cases, a very poor trade-off for that overall wealth erosion.
Your points regarding the total return underperformance are certainly clear, and I do acknowledge that those disparities can be quite substantial, especially with volatile underlyings. But does that necessarily negate their value for an investor with a singularly focused income objective? For the income-focused investor, the calculation might not be about maximizing an abstract total return number that includes unrealized gains. It might be more about the immediate utility of consistent cash flow, the ability to meet present financial needs. The perceived underperformance in capital appreciation is perhaps a known and accepted trade-off for getting that consistent cash flow.
But is the cash flow itself truly consistent or sustainable? That brings me to my next major concern.
Okay.
Which is the actual sustainability of these distributions. Because the distributions from YieldMax ETFs demonstrate, I think, a clear and concerning trend of continuous decline over time. This makes their long-term viability highly questionable. TSLY serves as a really stark example here. Its monthly distributions plummeted from around $2 at the end of 2022 to just $0.30 by August 2025. That's only 15% of its initial payout.
That's a dramatic drop.
It is, and over nearly 3 years, TSLY yielded a pre-tax total return of a mere 4.4%. I mean, you could have easily beaten that with a standard high-yield savings account with far less risk. And the widely publicized monthly income figures you see these online, like Richie B reporting $93,935 from Misty, they often obscure the simultaneous and far greater loss in share value. His 15,000 shares of Misty, for example, depreciated by $120,000 between May and August. So even after getting those dividends, he had a net loss of $26,000. These distributions are clearly not returns for life. They almost certainly will decrease, maybe with occasional temporary spikes around earnings when option premiums get briefly inflated. This structural characteristic, in my view, firmly establishes them as a yield trap for those seeking enduring income, not a viable path to financial independence.
I appreciate you raising that crucial point about distribution sustainability. And yes, the TSLY example is certainly stark. However, I think it's critical we don't generalize one, perhaps particularly volatile example as definitive for the entire asset class or strategy. While it's absolutely true that distributions can and indeed do fluctuate, reflecting the dynamic nature of options premiums and market volatility, this inherent variability doesn't automatically negate their fundamental value as an income-generating tool, at least for its intended purpose. Some ETFs, like Misty you mentioned, have actually shown a more robust capacity to sustain payouts more effectively than others, even if perfect constancy isn't achievable. The very nature of selling covered calls dictates that premiums, and therefore distributions, will respond directly to market conditions. That includes periods of higher volatility around earnings announcements, for instance. For an investor whose absolute priority is cash flow, managing these expected fluctuations becomes, well, an integral part of their overall strategy. The aim is securing a reliable, albeit variable, income stream. The ability to collect substantial monthly premiums, even if they show some decline over an extended period, still provides a regular income flow that many traditional investments simply don't offer, particularly not without demanding active management from the investor. I think it's more accurately viewed as a sophisticated tool for active cash flow management rather than some kind of set-it-and-forget-it guarantee. And for a specific investor, that distinction is, well, it's paramount.
That's an interesting point about managing fluctuations being part of the strategy, but it leads us directly into another critical aspect, one that I think often causes significant investor misunderstanding: the complex tax implications of these structures. A common misconception surrounds the tax treatment of what's often labeled return of capital, or ROC. Many investors incorrectly assume ROC distributions are entirely untaxed. That's a significant misinterpretation.
Right. It's deferral, not avoidance.
Exactly. In reality, ROC is a tax deferment, not a true tax avoidance strategy. When an investor receives ROC, it legally reduces their cost basis in the shares. Now, if those shares are subsequently sold for a gain, capital gains tax is incurred on that adjusted, now lower, basis. But even more critically, if ROC distributions eventually push the investor's cost basis below zero, which can happen with high payouts, all subsequent distributions are immediately taxed as long-term capital gains. This happens even if the shares are never actually sold.
Okay.
So, for instance, an investor who initially bought Coney at, say, $15.97 and later received $14.68 in ROC would see their cost basis plummet to just $1.29. Any future distributions, once that basis hits zero, would then become fully taxable events, regardless of whether they sell the shares. This inherent complexity frequently leads to an unpleasant surprise for investors who are perhaps anticipating a tax-free income stream, thereby fundamentally undermining one of the perceived key benefits.
You accurately articulate the technical distinction there regarding return of capital as deferment rather than outright avoidance, and that clarification is important. However, for a truly cash flow-focused investor, the immediate deferral of taxes on distributions can itself represent a significant tactical advantage. This mechanism allows the investor to receive and potentially redeploy a larger net amount of capital in the short term. You don't have that immediate tax drag that typically accompanies, say, traditional qualified dividend income.
In the short term.
In the short term, yes. This provides greater financial flexibility and immediate purchasing power, which are precisely the attributes that an income-focused investor often prioritizes. While it's true that taxes may eventually be paid either upon sale or if the basis drops below zero, the deferral itself is a valuable feature for effectively managing present-day cash flow and optimizing the timing of tax obligations. This aligns directly, I think, with a strategy that emphasizes the immediate utilization of income, making it a potentially powerful component for those who understand how to leverage it within their broader financial planning. So, to conclude my position, for retail income investors whose primary objective is generating significant, consistent cash flow to support their financial goals, these high-yield covered call ETFs, like those from YieldMax, can undeniably serve as a potent, albeit specialized tool. While yes, acknowledging the necessary trade-offs in potential capital appreciation, their demonstrated ability to deliver substantial monthly distributions provides an immediate and tangible income stream. This remains, I believe, a compelling proposition for those who prioritize that immediate cash flow over long-term capital growth, perhaps for supplementing retirement income or aiming for financial independence sooner. The financial landscape offers a diverse array of tools. And for a specific segment of investors, these ETFs fulfill a crucial and, I'd argue, legitimate role in income generation by delivering on their core promise of direct, usable income.
And to summarize my perspective, ultimately, the structural design of these high-yield covered call ETFs inherently, I believe, leads to severe underperformance compared to their underlying assets. It leads to a continuous decline in distributions over time and a detrimental erosion of capital. Despite the often enticing marketing of high yields, the long-term reality for many investors is frequently a net loss, even after you carefully account for all the distributions received. Furthermore, that perceived tax benefit is often a misleading deferment that merely postpones an inevitable tax burden. Investors seeking genuinely sustainable passive income should exercise considerable caution here. Historical precedent, I think, strongly suggests that such products, while they might experience periods of popularity during certain market cycles, consistently fall short of their long-term promises.
They unfortunately tend to erode rather than build true wealth for their holders in the long run.
Right. I think both of our perspectives really underscore the critical importance of thoroughly understanding the intricate mechanics of any investment, particularly when income generation is the primary goal.
Absolutely. The analysis of these instruments necessitates a very careful, very deliberate consideration of one's individual financial objectives and, just as importantly, unique risk tolerance.
Agreed. There remains much more to explore and learn in this nuanced interplay between the pursuit of immediate income and the essential preservation of capital within the dynamic broader market.
Indeed.
And for more in-depth financial insights and discussions like this one, please remember to like and subscribe to Finbot Insights.